All right, let's talk more about the markets, what to expect this week as earnings season kicks off. Joining us now is Carey, head of U.S. small and mid-cap strategy at Bank of America Securities, and Sarat Sethi, managing partner and portfolio manager at DCLA. He's also a CNBC contributor. And Jill, I don't want to bury the lead, but I don't want to emphasize it too much. But you like value. You're watching earnings, and the revisions have been historic, obviously. But when it's all said and done, you think the biggest gains for 2021 have already been had, and we may end at where we are, maybe down from here by the end of the year?
That's right, and thanks for having me. We do expect this is going to be a great quarter for earnings and really a great year for earnings, and that's what last year the valuations of the market reflected. We saw last year's returns driven essentially entirely by the multiple, the PE ratio of the S&P 500 expanding, and so this year is more about those earnings coming through. Sentiment is already very, very euphoric for the U.S. equity market, so we do think we're going to see an earnings beat this quarter. A lot of the early reporter results, macro indicators we're looking at are pointing to a beat versus consensus. But, we don't necessarily expect that will be enough to continue to drive the market higher from where we are right now.
Sarat, do you have similar sentiments? I know it's more about stocks with you, but we have had a good run already. And, if you look at long-term expected returns, for stocks, it's about 7 or 8%. We've already had 15. Does that mean that we should at least consider raising a little cash, or no?
I wouldn't go to cash in any way. I think the market has definitely discounted, as we just said, pretty good earnings. And I think at 21 times earnings, that multiple's got to come down a little bit. But I do think bottoms up if you look at different areas where, if even the financials trading at, 20% market discount, something like a Morgan Stanley there, or if you look at secular growth stories. What's going to be important, Joe, in this earnings season are a couple of things. One is who can have revenue growth and keep their operating margins. I think revenue growth without operating margins, i.e. higher wages, is going to hurt stocks. So going forward, even if the S&P stays at these levels, you can win if you've got stocks that are going to do well through a period like this. And if you can't, raise your prices, or you can't raise revenue, you can't expand, I think those stocks that have already reflected really good futures are going to get hurt.
So, Joe, we go back and forth. I want to drill down on why you think value makes more sense. I don't think you like industrials much either. At least you went to equal weight. What's your overall sort of feeling? Why do you end up there in terms of value and not liking industrial?
Right. I mean, so we lowered industrials from overweight to equal weight within our S&P 500 sector strategy recently. A lot of that is due to the fact that industrials has done well. The sector is re-rated. It's no longer, cheap as it was. And, as we see rising wages, this is one of the sectors that's more at risk there. So obviously, so far so good on inflation with respect to overall S&P 500 margins. Consensus has been, consistently kind of forecasting worse than we've seen. And inflation has actually been a positive so far for corporate earnings. But as wages now start to see more pressure to the upside, that's a sector, in addition to consumer discretionary, that's more labor intensive, a high ratio of employees relative to sales for the sector. So, that one, I think it's still a higher quality sector, but, that sort of caution could be warranted. Value is an area, though, that we still like. I think, value stocks are slated to see higher earnings growth over the next, 1 to 2 years than growth stocks right now. And we're only about 10 months into this value run. Historically, longer term value runs have lasted over 30 months on average. And you could still see these growth head fakes of shorter term bursts of growth outperformance within them. So we don't think the value run is over yet.
Shepard Smith here. Thanks for watching CNBC on YouTube.